Welcome to Accounting 201 Financial Accounting at Kapiolani Community College. This video will talk about Chapter 8 and accounting for accounts receivable and notes receivable. The generally accepted accounting principles approved method of dealing with accounts receivable is to use something called the allowance method of accounting for bad debts. Not all accounts receivable will be collectible. To deal with this reality, accountants estimate the amount of accounts receivable they think will be bad in the future and count them now as an expense of doing business. What are you trying to do when you're doing that? First of all, you're trying to get your accounts receivable showing at what they're really worth. That can be called net realizable or cash realizable value. This is in line with the accounting principle of conservatism, where accountants do not like to overstate the value of anything. Secondly, we want to try to get bad debts expense, which is the expense of us having accounts receivable that we can't collect, aligned with the period where the related revenues that led to those accounts receivable that are bad were earned. In other words, we want to match the costs of having our bad debts or uncollectible accounts as closely as possible with the period where the accounts actually were created. So that's in line with the accounting principle of matching. Two new accounts you've never seen before. One of them is the allowance for doubtful accounts. This is the amount of accounts receivable we think we're not going to be able to collect. You'll find this on the balance sheet in the current assets subsection as a contra asset. In other words, it's subtracted from the related accounts receivable. Also, bad debts expense you'll find on the income statement as an expense. It's an operating expense, and the technical correct way to explain what it is it's how much the allowance account changed by this year, typically larger. We report accounts receivable, as mentioned, on the balance sheet in the current assets section as an asset, and the related contra account, allowance for doubtful accounts, gets subtracted from it to yield net realizable or cash realizable value, like shown in this example. Several important things to note about accounts receivable, and these are easy targets to anticipate in an exam in terms of popping up as a multiple choice question. First of all, when you adjust the allowance account to whatever you need it to be, that's when you create bad debts expense, and that's when net realizable value drops. Secondly, when you write off an account receivable, when you say that that account receivable is not going to be collectible, that does not create bad debts expense, and that does not make any change in net realizable value. You would think it would. If it did, you'd be using the direct write-off method, and that's not GAAP. So we're not using that one. We're using the allowance method. Third, when you reinstate someone you've previously written off because, say, they come in to pay off an old account receivable, they finally got enough money to pay it off, that doesn't actually change the net realizable value, but the fact that you're collecting from them does. So, in other words, these things are things that you can expect to see in a multiple choice question, and if you can recall the answer to them, then you'll recall the correct answer from multiple choice. Next, the new balance of the allowance account, net realizable value of accounts receivable, and bad debts expense can all be anticipated in this way. When you write off an account receivable, there's no change in your cash or net realizable value. In other words, the amount of accounts receivable you still expect to collect is still expected to be collected. There's also no change in bad debts expense because bad debts expense was anticipated way in advance of actually writing off anyone in particular. Only the adjustment of the allowance account and collecting of accounts receivable actually reduce your net realizable value. We'll have a handout dealing with the allowance account, and you can see examples of these things occurring on that handout. There are two approaches for using the allowance method, but we will cover only the balance sheet or percentage of receivables approach, though you may be asked to explain the difference between that and the percentage of sales approach in a Wiley Plus question. The primary goal of the balance sheet or percentage of receivables approach is to try to get your accounts receivable stated as fairly as possible at its net realizable value on the balance sheet. Bad debts expense will be the result of whatever you've done to change the allowance account. Typically, increasing the allowance account will create bad debts expense for the period. To compute the amount of the adjusting entry, you need to look at how much you need in the allowance for doubtful accounts as its ending balance. You look at that ending balance that you want in the allowance for doubtful accounts, you subtract the current balance that you have in allowance for doubtful accounts, and that's the amount that you'll need to use in the journal entry. That's also going to equal your bad debts expense for the year. So in this sense, bad debts expense is only a byproduct of adjusting the allowance for doubtful accounts account. Typically, to look at how much you need in the allowance for doubtful accounts balance, accountants use an aging of accounts receivable to estimate how much they think the uncollectible amount will be. Here's an example of various accounts receivable of various ages. You can see the receivables from particular customers are spread out over several columns, indicating whether they're not yet due, they're overdue, and if overdue, how overdue are they. When you total up each of the columns, you'll find that you have $1,900 of receivables that are pretty overdue, $2,000 that are kind of overdue too, and $3,000 that are somewhat overdue. If you look at the age of each of these receivables and consider past experience, you'll find that the more overdue the receivable is, the higher the probability it will not be collected. So what are we looking for? Allowance for doubtful accounts, the amount of accounts receivable we expect not to be able to collect in the future. So we'll take these assumed percentages of accounts receivable uncollectability, multiply them by the dollar amounts in each of those categories, and calculate how much we think our allowance for doubtful accounts ought to be. So typically, if we're going from nothing to creating an allowance for doubtful accounts, at that same point in time, bad debts expense would be exactly the same amount. However, if we're moving from having a previous allowance for doubtful accounts to having a new balance in the allowance for doubtful accounts, this is just the new balance that we'll want. We'll have to subtract the old balance in order to calculate how much our bad debts expense and the amount we'll be using in the adjusting journal entry should be. So here are some typical journal entries when using the allowance for doubtful accounts. First of all, when we adjust the allowance account, we'll debit bad debts expense to increase that expense account on the income statement and credit allowance for doubtful accounts by however much we decided we needed to change it. That's using this computation here. Secondly, when we actually write off an account receivable, discover that it's uncollectible and make it go away, we debit the allowance for doubtful accounts to compensate for us crediting accounts receivable for that particular customer. So now we will not even consider that we're getting anything from that customer because we've determined that they're uncollectible. Last, if we reinstate a previously written off account receivable, we'll do the opposite of this entry right here, and then we'll do a collection. Why do we do that? So that we can show the last thing occurring with a customer is collection of the cash from them. That way, if we need to review their behavior for possible future credit capability, we'll have on record that they did in fact pay in cash. Other things we can do with accounts receivable, cashing them out is one method of receiving cash for your accounts receivable. And a method of doing that is called factoring. Factoring involves you going to a factoring agency. Typically a bank has its own factoring unit, and in there they'll provide you with cash for your accounts receivable. Those accounts receivable then become the property of the bank, and the bank has now the right to collect them. If they become uncollectible, that'll be your problem to come up with the cash to pay back the bank for that bad receivable that they bought. So it's a two-edged sword. Another way of getting cash quickly instead of receivables is using credit card sales. So there's a kind of a receivable there, at least for a little while. If you have a bank credit card, for example a Visa, you'll get the cash right away as soon as you make the sale, just a service charge expense as a part of the cost of doing business with the credit card company. If, however, you have American Express, there'll be a slight delay, so you'll have an account receivable for a short period of time, and they'll charge you a service charge expense to go along with that amount that they've enabled your customer to quote unquote pay you. However, you are assured of getting your money because the account receivable is from American Express, not from the customer. Notes receivable are a signed written promise for us to get a certain amount of money in the future, and they usually bear interest. This gives us a stronger legal claim for our money, and they can also be sold similarly to accounts receivable. Here are some standard entries for notes receivable. For example, if we make a sale to the customer and we receive a note from them, say it's a large dollar item or some other reason why we need a note receivable, we'll debit notes receivable for that customer's name and credit sales. Or we may somehow or another loan someone money, we'll debit notes receivable and credit cash. Or a customer may say they're not going to be able to pay us soon. Can they sign a note to give us a little bit more assurance that they'll be paying us sometime in the future, just not now? And then we'll swap an account receivable for the note receivable rather for the account receivable. If we collect an account receivable within the same year where we've issued, a note receivable within the same year where we've issued the note receivable, it's very easy to calculate the interest. You just take the principal amount of the note times the interest rate times the time factor. And the time factor is typically a fraction of a year. The rate is typically the annual percentage rate. So we can calculate our interest due on the date that we collect the note receivable by taking the principal amount of the note times the interest rate times the time factor. Often the time factor is a tricky item. This is especially so in light of the fact that Wiley says to assume a 360-day year in all computations dealing with notes receivable. So the normal 365-day in a year rule does not apply when doing their calculations. Thus, if we're going to calculate how much note receivable is due from a customer, we'll calculate the amount of take the amount of principal that they owe us, and then add the interest that we have calculated. So if we wanted to do a simple calculation, we could take an assumed principal amount of, say, $20,000, an interest rate of 4%, and let's assume 3 months of time, or 90 days. My time factor then will be 90 divided by 360, not 365. And the dollar amount of my computation will come out to 20,000 times 4% times 90 3/60ths of a year, or $200. The principal amount plus the interest then will yield my maturity value, or $20,200, as you can see from here. So, what happens when you come to the end of a year? When you come to the end of a year, you can use my Excel multi-column sheet to do the computation and come up with a reliably correct number that allows you to submit your Wiley Plus the first time with confidence. To do so, take the file known as Interest Accrual Worksheet, or Chapter 8 Interest Accrual Worksheet. Put the dollar amounts in that are given in the problem that you have in Wiley Plus, and use the formula like the one I just showed you, however doing a little bit of date math to come up with the days that are need to be accrued. So we're looking at how much interest we have earned but not yet received as of the year end on these three different notes receivable. My formula does principal times rate times the calculated time, and I take it, I copy it down, and it does that for all three notes, and then I can simply sum it up and get the grand total of my interest accrual. So the dollar amount to use then would be the amount that I calculated there, debit interest receivable and credit interest income. If, however, you're going to collect a note receivable in the following year, you've done this interest receivable year-end accrual at the end of the previous year, then you have the receivable amount for that note sitting inside of interest receivable, and you need to zero out interest receivable along with notes receivable when you do the collection. Let's say, for example, we had a note receivable with a maturity value of $33,000, so that's $30,000 of principal, $3,000 of interest, and we'd previously had $500 of interest receivable accrued on it. The remaining $2,500 of the interest component would be interest income for this future year, and $500 would be for the preceding year. So we'd have 4 accounts involved in our journal entry to recognize the collection of that note. If you have a dishonored note receivable where the customer doesn't pay the note receivable when it's due, the only thing you can do with that is hope that they will and take them to court or do whatever else is necessary to try to do the collection. But account-wise, the note receivable is no longer a valid note receivable because it's exceeded its maturity date. So you will turn it back into an account receivable. Debit accounts receivable, credit the note receivable. Last thing, let's take a look at financial statement analysis for our receivables. Accounts receivable turnover, or average collection period in days, are considered liquidity ratios. Those look at your capability of generating cash when you need it. This is how well is management managing its accounts receivable, because they do need to actually be managed. The higher the turnover, or the shorter the collection period in days, generally the more efficient management is being in their management of accounts receivable. And you can compare this ratio that you'll get to yourself in a preceding year or to other companies like you in your same industry. To calculate the turnover, you take net credit sales divided by your average net accounts receivable, so that's accounts receivable minus allowance, beginning of the year, end of the year, add together, divide by 2, and that'll give your average net accounts receivable. Divide that up into net credit sales, and in this example I got a 6-time turnover. If I look at 365 days as really being the number of days in a year and my 6-time turnover, this means on average I'm collecting every 60.8 days. If this is normal for me and normal for my industry, then great. But I would guess in most industries it's probably very slow. So that would not be a good thing, and this would be an average that you would want to try to increase the turnover and reduce the collection period in days to further refine your management of your accounts receivable. Thanks for listening. Hope this helps.